What is up, everyone? I'm David,
And I'm Monique.
and welcome back to episode 5 of Nature of the Business podcast. We're going to be talking about one of the most important aspects of building a business, and that's how you capitalize your business. There's a quote that says that to every business, revenue is oxygen. Every company needs some source of cash to survive. YGN, we probably have tried pretty much all of them. So we want to share that with you and have a conversation of some of the ups and downs of taking these different types of funding. And as always, so we're going to start from the beginning, Monique, and let's talk about how you capitalized YGN for the first few years of the company.
So from day one, I didn't have any money. So I started with just my hands, sweat equity, and fabric. And so that was part of the reason. Last episode we talked about how YGN was mostly made to order when we started. That was part of the reason why that was done that way, because I didn't have the money to invest in inventory up front. And so that's how I started. It was really just using whatever resources I personally had and reinvesting them back into the growth of the business.
Yeah. When you first started out, how did you think about capitalizing business and funding the growth? Everyone wants to grow really quickly, but there's a certain element of gravity that comes with that growth. A lot of times you just think, okay, great, it's off to the races once you start getting sales. But what are some of the nuances about growth and capital that's required about growth that you had to learn early on?
As you grow, you do have to build your staff with the growth of sales. And so sometimes your profit can cover that, sometimes it can't. Sometimes your profit can cover the additional materials you need. Like we had to buy fabric up front to fund the orders that came in. Sometimes it's not enough. And so that's when it helps to have some sort of funding, whether it be a loan or an investment or whatever it is, to begin to fuel the growth that you've built into the business.
Mm-hmm. Before you had the factory, how did you think about every step of growth? So, for example, there are certain moments that happen that every business goes through that are very costly. And so, how did you navigate some of the more costly, unexpected events that happened with the business
Before the factory,
before the factory? Yeah.
I really honestly didn't have the luxury to, I don't know how to explain this. I didn't really have the luxury to have a whole bunch of money to buffer us for those things. Now, I had a limit on what I had a limit on the amount of cash that I wanted in my account at a time, and I did hold myself to that. That was my indicator of when things were going right and when things were going wrong. And that kind of helped us to stay stable throughout the years before we opened the factory. And it did cover a lot of the issues or mistakes that inevitably arose.
What was the first any type of outside non-revenue funding, whether it be a loan or whether it be a credit card, or what was the first kind of outside pre-investment of capital that wasn't just cash?
Right around COVID, I did get a PPP loan and a disaster loan at that time. And that was the first time in I guess it was 3 years that I had run the business that I had any outside capital in the business. It was all just using the cash that I made and reinvesting it into the business.
And how did that outside cash impact the business?
But what it did was it gave us a safety net. I didn't really spend much of it for a very long time. It literally just sat at the bank account. But it gave us a safety net to feel comfortable to open a factory, to have a staff, to be running payroll on a biweekly basis. Having that type of liquidity in the bank allowed us to have that level of comfort to grow.
Yeah. And imagine a world in which the PPP loan COVID didn't happen, PPP, if you can. How do you think that path of YGN would have looked like what do you think that world would have looked like outside of that PPP loan?
At that point, I think we were becoming stable enough and had strong enough revenue that we could go out and look for loans in the bank. And so instead of that, we did the PPP because of the timing of things. But I think the next step likely would have been to go to a bank and look for our traditional.
Mm-hmm. Got it. For the listeners out there, what are the requirements of an entrepreneur or someone who has a business idea to get a business loan? Now, you can go out and get a personal loan depending on how much cash you already have in the bank and or your credit lines and those types of things. But what are the requirements if you're looking to go out and get a business loan from the bank?
You do need a business bank account. You have to have your business properly structured with the government. You have to have your paperwork in order in that sense. From what I have seen, you do need to have your previous year's tax returns. You need to have statements of cash flow and revenue. And so those things, a bank typically wants to see those things in order for at least 6 months before they're able to consider you for a loan.
Got it. Yeah, it's interesting. You read online about, oh, if you're a business, this is how you get a loan. A lot of times, at the times where you're going out and looking for the loan, you think, okay, I'm going to go into the bank and I'm going to go get a loan. It takes a longer time than you would imagine or think or realize when you're going out and getting a loan. You want to talk a little bit about what you've seen for how long that process might take?
Yeah, well, it depends on the type of lender you're going with. There are some lenders out there that are more expensive that will basically get you approved in a day or two, but you're going to pay for something like that. Now, if you're going directly through a bank, typically they're going to take your past 3 months of bank statements and take a really deep dive into those documents and make sure that they can approve you for a loan.
Mm-hmm.
That approval process can take anywhere from 2 weeks to a month or so.
Yeah. Yeah. And then sometimes they also look at your personal financial situation, because if something goes wrong, or probably also if they're going to give the company money, they want to make sure that you're not just going to use that for your personal purposes.
And that's absolutely correct. Typically, unless you have, I think the number that I read was $10 million in revenue, is that they will look at your personal information in order to put a personal guarantee on the loan.
Mm-hmm. So you took on the PPP loan, we opened the factory, and then the company really started to scale. Do you want to talk about that period of time of opening the factory and the company scaling?
Yes. Shortly after I opened the factory, we actually decided to raise money for the business. So that's when we took on $2 million from investors to raise money for the business. And from there, we began to scale mostly our Facebook ads, which allowed us to scale our order volume significantly for the business. And from there, it was really just a matter of chasing that demand with building our operation here on the ground.
As you look back on that round of funding, what was your experience with the fundraising process of going out and actually getting funding for YGN from investors, angel investors, and venture capitalists?
So it was a really new process for me. I had never done it before. I actually knew not very much about the space as far as venture capital goes. And so I really actually was just following your lead as far as like how to go out and raise money in that way. What I learned from the process was really just how to tell our story and how to really create a story around the brand that we've been building, because a lot of times when you're inside of an experience, you don't know how to explain it from the external sides. And so I really learned how to put some perspective into my view on the business and write a story around that.
Yeah, I had raised money in past startups. And if you've ever run a marathon, maybe you haven't, but you have this idea of what it's like to run a marathon. But then when you're actually running, it's hard to explain what it's like outside of actually going through the process. And a lot of times people are like, oh, I need to go out and raise funding, or I need to find an investor for my idea or my company. And people do go out and raise money from investors without having any revenue. Going out and getting money from angel investors, or you don't have the same stringent requirements that you typically see from a bank, where you have to have revenue requirements. And in fact, in some ways, it benefits you from not having that background, because investors, especially early stage investors, they're betting on the future of the business. They're betting on what this business can become. And so the less real numbers that you can track, the more the story can fill in the gaps. Conversely, when you're going in and getting a traditional loan, they're only looking at the past to define what's going to happen in the future. And we were going through this with YGN, is that we did have revenue. And so there was a multiple on the company based on what we had done revenue wise. Fortunately, we were growing at a pretty fast clip. And at the same time, we were going through this rise of direct to consumer brands where investors were really keen on investing in direct to consumer. So you had a lot of brands like Casper and Hims and Allbirds. The shift was that with the rise of e-commerce and behavior change in Shopify, there were all these companies now that didn't have to go through the traditional channels of Amazon or be on Walmart, and they could build their own brand. So I think that was definitely an interesting time as far as direct to consumer and VC interest was. And during COVID, people weren't buying as many things in store. They couldn't go into stores. And so we all thought that the behavior to shop online would go as far as you could imagine. That's what people would do from 2021 into the future. It's an interesting moment that we raised in. Different people had different ideas about raising venture or angel investing, taking on investors. I always say you want to think of venture capital as rocket fuel, not gas, in that you need gas to start your car and go. You can't go anywhere if you don't have any gas. You need to have something that shows that you have traction and meaningful traction. And even more importantly, you have an aspect of your business that you're super sure about. And YGN had been around for 4 or 5 years before we went out and raised the first round of funding. And so I think that's something that if you raise too early, then you don't have any backstop because you've just been running the business based on your venture funding. And if at any point it's hard for you to raise money or you can't raise more money, then you don't really know how to run the business outside of that. And so it's almost like you've been taking steroids the entire time. And then once you have to come off the steroids, then you shrink.
So what would you say is for companies that are still in the ideation phase, what would you say is the best type of company or best candidate for VC funding?
I would say that obviously software companies are great candidates because their margins, if they win or do things right, they're going to be high. They can be absorbed pretty easily by another company that might buy them. If you are in a high science, really difficult industry where the revenues aren't going to come for years in biotech, for example, you have an idea, you have a compound, you have some scientists, you got to pay the scientists. It takes 10 years for the drug to get approval. Something has to fund that. And typically you can go out and get investor money for that. It also depends on the industry and the time in industry. So I had previously raised money in ad tech, and we knew that there was going to be a shift. At the time, all the advertising was going from, hey, Essence, can I advertise on your site? And they tried to bundle you with a magazine, and they tried to bundle you with all these other different things. And that wasn't efficient, especially as more websites grew. It was harder for them to sell those impressions on the website. So you needed technology to support this new advertising ecosystem. And the space that I raised in is called ad tech. And so it's still technology, but advertising. And so any industry that you think that there's disruption that's going to be happening, and you can somewhat project out that, okay, this is going to be a big opportunity that we really think we need to go after because you need to get out ahead of the market. And when we get there, you know that there's some like us getting out beyond where everyone else is to establish our beachhead. That's really why you'd want to raise venture or angel funding, is to get out ahead. It happens in different industries.
Interesting.
Yeah. So we raised the $2 million, taking on investors. After we raised, what were some of the learnings that you had, Monique, around what having investors actually means to a CEO, to a founder when you raise venture or angel investment?
I think one of the most surprising things to me was the focus on very fast growth. So now we were trying to hit numbers. And that part of it was something that was what we were chasing. And it pulled me away from being able to really think about the organic growth of the business.
Yeah. And really, you can grow a business, like you said, in a very organic way. And there is a especially when you have investors, there's an excitement around traction and around growth. It is somewhat of a treadmill, is that when you raise money from venture investors, the way that venture funds are constructed, it's usually like a 7 to 10 year arc. And those venture capitalists, they have investors themselves. So they're saying to some other investor, I'm going to take your money. I know startups. I'm on the ground. I can find the best startups. I'm going to bet on those startups. And I bet that 7 to 10 years, I'm going to show you 3 to 10x return on the collective investment. And with that being the case, venture investors are also interested in growth. They're betting that they can kind of outpace the market. There's certainly a focus on growth in those cases. Whereas if you're growing yourself, you can decide, this isn't the right time to push, or this is the right time to push. And if you're taking on a loan, the loan is pegged to your past. So it almost is a force function. You're not going to get more leverage than the banker says. As far as alternative to get cash, what are some places that you think are the underappreciated ways to fund your company for people out there who are like, man, this is really hard. I'm trying to invest in next season's inventory. That tension between the investment that you have to put into your business today to operate it and the investment potentially for the future of the business. What are some creative, underappreciated ways that you have seen to fund your business?
A lot of the platforms, because e-commerce has become such a democratized process, a lot of the platforms do offer capitalization. If they start to see you growing, they'll offer you what they'll call a cash advance, which isn't technically a loan. Basically, they're purchasing your future sales. So what they'll do is they'll peg your payment amount to a certain percentage of your sales for that day. And so if your sales are slow for that day, you don't have to pay as much that day. If you have a high sales day, you'll have to give them maybe 20 or 30% of your sales for that day. And it's more expensive than a traditional loan. It's definitely more expensive than raising money or having investors. But if you understand your business model well enough, you understand your profit model well enough, and it works within that profit model, it's actually a really great tool for people who are coming up, because it's not something that's pegged to your personal credit. They don't ask for a personal guarantee, and they don't put you through a bunch of hoops in order to get approved.
That sounds amazing. What are usually the criteria when you say you're growing or getting revenue? What are usually some of the criteria that you think, obviously you're not sitting in those rooms, but at what points do you think like they say, oh, this company looks like they're doing pretty well revenue wise? What are those? What do those look like?
Yeah, obviously I want to preface with I'm not an underwriter, and I don't have all of the full underwriting model for what it takes, because even starting out, we had our returns running through a Stripe platform, and even with that small amount of revenue, they were able to offer us a small loan from that. So I don't know exactly how much it would take to be approved. I do know that if you have a healthy account that is running revenue through consistently, I believe what they say on their FAQs is 30 to 60 days, you can be considered for a capital loan through them.
And what are the downsides and risks? It sounds like a dream, right? Yeah, I get some revenue and...
It's definitely not a dream.
Yeah.
It's expensive. What it typically rolls down to is the fee that they add on is typically about 20% of what they've given you. 20% loan in any world is expensive. And then on top of that, your daily revenue is, you chip away at some of your profit by doing this daily payment. And so it's an expensive loan. If it works in your profit model, then that's something that you should consider. You should never take on money that you can't afford. But absolutely, it's a way to, in a world where it's not as easy to get a traditional bank loan, or if you're not quite ready to go raise money.
Yeah, I think that it really is an interesting idea, that the most important thing, I think, with any outside capital that you're pointing out is you need to know your numbers of your business. If you don't know your numbers of your business, whether they're customer acquisition costs, whether you're talking about a bank loan, you have to know your numbers, because you have to get the loan officer to get approval for your investment. And then with these easier loans, there's almost more risk, because if you say you only have 20% margin on your product between any advertising you're spending and the cost of your product and any other costs that you might have, and you take on one of these loans, you're now losing money because you borrowed that money. And so it's really important, as Monique points out, to know the economics of your business before you go out and raise capital, because without knowing those economics, then it's going to make your life a lot harder to raise any type of capital. But two, with the easier capital you get, you don't want to have any surprises there.
Yeah, that's absolutely correct. And it's easy to get caught up in that when the money's there. All you got to do is click a button, it'll be in your bank account. But it is important to be careful of how much revenue you give away when you sell into these capital advances.
Yeah. So we're mainly talking direct to consumer brands, and we've been in Target for the last year, and we're going into CVS, and we're in Bloomingdale's, or maybe we might already be, by the time you're hearing this podcast, we will have already been in CVS for a few weeks. And so that also requires capital when you're going into a retail partner. What are options in those cases?
But when you have a PO, it makes things slightly easier. It does give the underwriter something to say, oh, okay, if we can just help them get this order completed, that's guaranteed revenue on the other side. And so for PO financing, if that's what it's called, what they'll do is they'll look at the PO, they will also take a look at your business numbers, your cash flow and your P&L, and they'll make a decision on whether they can give you money just to purchase the materials and fill the manufacturing order to create that PO.
Yeah.
And that, like I said, it's a less stringent underwriting process from what I've experienced, because they have something in hand to say, okay, we have some guaranteed revenue here.
Yeah, it's interesting. All of these doors open up once you start to have traction and have a real business. And so the refrain is, the best way to capitalize your business is when you have a business. And so that does inevitably, unless you have an angel or a friend or a family member who can help you get to that point of having a business, things are disproportionately harder earlier on because you're still trying to build the momentum. And in a lot of ways, it's important to go through that hard time. It's almost like building the fundamentals of what the business looks like before you go out and get outside capital, because you need to understand how to bring in revenue, what revenue looks like, what your cost structures look like, because at some point you're going to run into bumps down the line, and you're going to need to know how to go back to those basics of how were we running this before, and how can we strip things down. If you're growing, you're going to have bumps, and economies go up and down, and product lines change, and product demand changes. And you can't stress enough, if you're looking for funding or you're looking for a loan, the most important part is feeling and knowing that you have been through some time of operating before you go out and raise capital. Even in the VC route, there are companies and people, if you have the background, to go out and raise money from venture capitalists and angel investors. It doesn't always mean that you should. And the only reason why I say that is because what then happens is that you are on the clock, and it's almost like fueling up, and you have to go to point A to point B, and you don't even know where point B necessarily is. And you don't know what potholes or traffic jams or any of those things are that are going to block you from getting to point A to point B. So there is an immense amount of risk in taking on funding early. And I also think that the companies that can figure out how to generate revenue and how to acquire customers before bringing on funding, that is the fundamental tool that will stay true whether you have funding or not. Is how do we get customers or users or people who are going to give us some type of value, because in that way you're not spending the money searching for that. So it de-risks it somewhat.
I would say also having a strong team in place ahead of funding is really important, or at least knowing who would join if you had the money to pay them. Because if you're building the business based on a skill set of people who don't necessarily know how to fully run the business, you end up in trouble in that same way, where you're looking to accelerate, but everyone's still on a learning curve.
Yeah, I think that's a great point. Conversely, I do think that there is value in venture capitalists and angel investors are filters for good entrepreneurs because they see so many deals and then they look at those entrepreneurs through a set of filters. And so they have a lot of information that we don't always know as entrepreneurs. And they have connections that we might not necessarily always have as entrepreneurs. And so there's the upside. Venture capitalists or angel investors, it is a little bit different in that potentially it can open up doors and introduce you to other entrepreneurs and people who you might not necessarily have had access to. And it's in their interest to do that work because they want to see you succeed. So they're going to try to, connect you with as many people as can be helpful. And so I think that is something that's a little bit different or about the other funding sources. As you were talking about team, as entrepreneurs, we are consistently taking a lot of risk, and just the nature of the business that we're in, the odds of failure are very high. It doesn't matter what company that you're starting. They just are. There's a 8 out of 10 to 9 out of 10 chance that you will fail. This is why you take on funding, is that it somewhat de-risks the risk of running out of money. And so you're always looking for ways to de-risk the risk of failure, and investors, partners tend to de-risk aspects of running the business. Okay, so we have had an experience that many people haven't had, which is being on Shark Tank. We were fortunate enough to raise some money from Mark Cuban. How is the Shark Tank experience different than any other capital raising experience?
Raising money on TV is much different than raising money in real life. You have to be exciting for TV, right? And it's a lot less of the nuts and bolts of the business and more of creating a TV worthy story in order to raise money. And so it was an exciting experience. It was tons of exposure there, but it's almost like comparing apples and oranges. You're talking the same numbers, but you're telling a completely different story.
Yeah, and on TV, when you watch Shark Tank, how do you perceive the companies that are on Shark Tank and the ones that get funding? And even if it's not YG, you're a seasoned entrepreneur at this point, and you're watching Shark Tank. A lot of people say, oh man, I just need to do these things and I'm going to get on Shark Tank. Or somebody said, what was Shark Tank as a source of capital? People do view that as a way to change the trajectory of their business from a marketing perspective, but also a fundraising perspective. Specifically from a fundraising perspective, how do you think about that?
I think that if you're very early on, and I've seen so many dog food companies on Shark Tank that just get funding and they don't really have much business to start. And so having a shark come in, have their face and their personality there, and maybe a couple $100,000, that's like changing for that business. We happen to be a little more mature. And the types of deals that they'll give on Shark Tank, they might want to take a fifth of your business. They might want to take half of your business for what would typically be a nominal amount of money for us, given the amount of revenue that we have. It really just depends on what stage your business is in. So for some, it could be, like I said, life-changing.
I think that's a great point, and something that we haven't even touched on yet. There, in the case of that art loans or cash advances, sharing ownership in the company. Up until the first round of funding, you had 100% of the company, and you don't have 100% anymore. How do you view ownership of the company now that you've gone through a couple rounds of funding? We have raised money from people at Sharks. We have employees who have percentages of the company. How do you view that aspect of shared ownership or selling ownership in the company?
I view ownership as one decision-making power. And I see it as when you give up you sell off part of the business, you can only do that pretty much once, right? So you do it the first time around. I think the first time around we sold off, 25% of the business, right? You only have but so many chunks that you can sell off. And so when you sell off a piece of it, I like to really what that cash is going to go towards and where you see yourself once that money is used up.
Yeah, I think about the shared ownership, and that trade of cash versus ownership is that the bigger we can all make the pie, whoever the investors, the entrepreneurs are, the team is, the more we all benefit. And there are two ways to do this. The first way is to convince people that the future of whatever venture that you're running is going to be super valuable, is an exciting opportunity that you would want, one would want to invest in. And so with that, people want to participate in that future. It's almost like crypto, right? Nobody knew what crypto was going to be, Bitcoin, whatever. And at some point, there's so much, you're almost like, oh, I'm missing out if I'm not part of that. And in that world, you can create enough hype where people just want to be a part of it. And then the other world is a very practical, as an investor in a company, as an employee of a company who does have equity. If this company triples in value, then my equity triples in value, or this company will 10x. My equity in this company 10x is in value. I like the idea of shared ownership in that it gets more people than you rooting for you and wanting to support you, because the more successful you are, the more successful they are.
Yeah, that's true. I'd say also it's a great thing to have when you're secure in how you're going to be moving forward. And I take every piece of equity as precious, because if I sell off this piece, I know that my next step, I should be very secure in what my next step is going to be.
Yeah, no, I think that's a very true thing. So did Shark Tank raise a little bit of money? Shark Tank is probably harder to raise money than any of those other options, in that you got to get onto the tank, and then you got to get on TV, and then you got to get it. So you're out there thinking, yeah, I'm going to get on Shark Tank, and then my company is going to blow up. You can, totally think that, but the odds are that, of the companies that are going on Shark Tank, maybe one, maybe two, their entire business is transformed because of that experience, and it's just really hard to get on it. So that's Shark Tank in a nutshell as a funding source. Let's talk a little bit about being in the Black hair care space. We talked about this on the Swim Turban episode, and we talked about this, I think, and maybe it's the third episode. It's just the origins of YGN. A lot of times people who don't know your space don't get it, right? It's just like outside of it, they don't really get why your product exists. Right. And so 7 years ago, there were Kickstarters, right? So you could go out, you could pre-sell your product with an amazing video. You would get people excited, and they would be your first customers, and they would fund your initial run of product. Kickstarter isn't as big of a phenomenon anymore, but there is the rise of these crowdfunding platforms. And we know, especially in the Black hair care space, Curlmix, one of our contemporaries, has done really well in that space. This is something that we're also exploring and preparing to do. I think that this is a really powerful idea. How do you view crowdfunding and the dynamics of it and the opportunities for it?
So because of the way that YGN was built, it's a very community-based brand. I really do feel best people to back us are our customers and our community, because they understand the value of the product the most. And they are going to understand what we could be if we can continue to grow on this idea of inclusive design around hair accessories. And so I really do think that it's good for brands that have built community and have a strong base around them to really bring value back to that community. And especially in the VC space where Black women are underrepresented.
Not sorta. I think they're 7% of the population, and they get 0.2% of the VC investment.
So very much underfunded. In that space, it's a way for Black women to support those who have been supporting them very disproportionately. Black people tend to want to support Black-owned brands in order to support community economics. And so that's something that we can give back to when we're raising money.
Yeah, and I really like this model because the return of success. Sometimes you can get misaligned. You see this with companies that go public all the time. Mine is Shopify right now, where Shopify is a public company, and they're increasing the pricing. Klaviyo goes public. All these companies that you, as a small brand, rely on, once they get to a certain size and they are focused on impressing their investors, then they become at odds with their customer. And I think for companies like YGN, who have raised outside funding from investors, and if we have other investors who are also involved, we want to think about collectively all of the investors, and it keeps us aligned, not just from a product perspective, but from a company direction perspective. Because once you become an investor in YGN, we have they call it a fiduciary responsibility to our investors. And so what that means is that we're aligned, and the people who have supported us can be a part of the company and be a part of the journey. And then, not to mention, we know about this in the Black hair care space. At some point in time, the founders get an offer from some big investor or some big conglomerate that wants to buy them out. And the founder typically sells, and the company changes because of that. And so if you have the community that is involved and can be involved in the dynamics of the company, it allows you to think about our investors. And if the community is there around the table as an investor, we do have to consider that. I also think about a lot of times venture capital doesn't necessarily outpace the stock market all the time, but it can. The most affluent people invest in the venture capitalists. And so they're investing in venture capitalists to get a higher return than the stock market. As a retail investor, there is more risk in investing in a startup, but you don't necessarily get returns that people who have the most money have access to. So there's a lot of dynamics that I think that, especially companies like YGN, making a portion of the company available and aligning with your community and the community supporting the company in that way can be a really powerful thing.
Yeah. And giving our community that's been so important to helping us grow the opportunity to benefit from our growth and share in some of our success is really it's part of our DNA anyway. So it's a really great way to grow.
Yeah. There really are so many different ways to capitalize your company. I think that great entrepreneurs are just going to find a way to, make sure that you don't run out of money. That part of that is some caution. Part of that is luck. There's a lot that goes into building a company in general. Knowing what funding tool to use, whether that's bootstrapping early on, whether it's a loan, whether it's venture capital, there's probably not a 100% right or wrong answer. And it does depend on what your situation is. As an entrepreneur, you got to capitalize your business in some way. I think that's the most important thing. And for most of us out there, it has to start with bootstrapping it. Is there anything that we didn't talk about as far as your journey?
I think that what it comes down to is really being creative, being very gritty and pushing through with any business. There are so many businesses that we know today that are so popular, so successful that we're nearly at zero or we're at zero at some point. So don't be ashamed to really think about your business differently. If you come to a point where it feels like failure, it doesn't necessarily mean it is failure.
Yeah, that's great. Thanks so much for this conversation. I think it's always great to look back at our options and share with community what we're thinking about. And as always, if anyone listening out there has any questions, comments, or feedback, don't hesitate to drop us a note on social, on our YouTube channel, or send us an email to natureofthebusiness@yougonatural.com. Thanks so much, Monique. Thanks so much, everyone. And we will talk to you guys next week. Take care.
Thank